welcome to everybody and thank you for joining us on today's session. My name is Daniel Tramontana and I'm from BGL Corporate Solutions, and I'm thrilled to be able to present to you Dr. Mark Pizzacalla from BDO, who is a partner based in Melbourne, also sits on the Australian Taxation Office Board. I've known Mark for a long time, and one of the things that I really appreciate about Mark is the fact that he's able to really dig into topics that can be quite complex and difficult and really simplify them for the audience and the people to understand. And today's topic, we're talking about the allocation of professional firm profits, the ATO compliance approach. And Mark, before we go into this, just welcome and thank you for joining us.
Thanks for having us. I really do appreciate it.
Yeah, look, and today's going to be an interesting discussion, and I've done a little bit of reading on this, and there seems to be quite a significant change taking place in this place. And the thing that I've noticed is that really any accountant that's really doing accounting work for firms or for businesses where there's professional services, or professional firms, this really does impact a huge number of people. And you know that we saw that the ATO released a compliance approach to allocation of profits for professional firms on the 1st of March 2021. And in a sense, you know, it's a draft guideline, but you know the new rules will apply from the 1st of July 2021. And there are some similarities, but there's also some significant differences. And as we work through this, Mark, I'm sure that you'll be able to bring some clarity as to what's taking place. And what I'll be doing is during the presentation, I will be looking at some of the questions together with Zachary and Mark. At the end, if we've got a few questions there, what I'll do is we will go through and we'll ask those questions of you. And if you can answer them, then that would be great. But I'll hand it over to you, Mark. Thank you so much.
Thanks a lot, Daniel. And again, thanks to everyone for attending. Look, this is a pretty important topic. It's been a long time coming. And as many of you would be aware, the reason for the interest is because it does have to do with the ATO's new compliance approach to how our firm profits allocated in professional firms to their partners, to use a loose term. So it's also important from the point of view that it doesn't just impact accountants, although I think many of you on this call might be accountants, but it certainly impacts a number of different professions, and we'll go through that as well. Now, before I start, just a compulsory thing to do, which is a disclaimer, and that is that, you know, these rules are new. They're going to be a little bit complex depending on the structures that everyone has in place. And so obviously you need to make your own inquiries to make sure that you're getting the right advice. And, you know, comments that we're making here are really just high level and not meant to cover, you know, specific scenarios. And before I go into the slides as well, Daniel's been good enough to allow me to share with you BDO's PPN network, and this is a network of accountants that we've got at BDO. You can join by simply going to the link that's on the website that's on the screen there, and essentially what it allows you to do is to be in touch with BDO in terms of all of our accounting publications, notifications, etc. So we'd love to have you on board as a member, and that entitles you to make telephone inquiries, come to our seminars, training sessions, etc., and regular news updates. So let's get straight into it. This is draft PCG 2021, draft 2, and it's all about, as I said, the allocation of professional firm profits. Now, the ATO released its proposed compliance approach on 1st of March 2021, and once finalised, it's proposed that it will operate prospectively from 1 July 2021. Now, there are some significant changes from the former ATO guidance, which was suspended in December 17. You will notice some similarities though, particularly in relation to the benchmarking formulas. It follows a similar structure for those of you that are aware about how they used to work. But there's also some differences, and predominantly these relate to the requirement that there are now 2 gateways. And what we mean by that is that there are 2 specific gateways you need to get through. And once you get through those gateways, you can then look at a traffic light assessment, risk assessment system, which is based on the usual benchmarks that you're ordinarily accustomed to. Now, The gateways, some people are saying that the gateways are in addition to the suspended guidelines, but I don't look at it that way. I mean, to me, they just more expand and clarify conditions and rules that were in place previously, but there's a lot more detail to those now. We've also got for you a link for you to go to those specific, the specific PCG as well. Now, why the new approach? Well, I guess the ATO has indicated that in suspending the previous guidelines, it was because they were being misinterpreted. There were some ATO concerns around a number of different issues, and we've just summarised here what they are. In broad terms and very high level, again, you know, there seemed to have been a lack of a commercial purpose around some of the arrangements that were being entered into, and I've got a couple of examples there around disposal of equity interest through a series of multiple assignments. Apologies, because my email is on. Creation of new discretionary entitlements, including dividend access schemes, and utilisation of amortisation, leading to differences between tax and accounting. And that's an interesting one, because I've spoken to a few accountants and lawyers about that, and there are differing opinions as to what that actually means, and we haven't really landed on common ground on that. There's also seems to be a disregard for CGT consequences. This is what they're finding. So this is not me saying this to you, but rather it's the information that we're getting about why a new approach was required. There were assignments where there was profit sharing, which wasn't directly proportional to equity interest that people had, creation of artificial debt deductions, assignments to SMSFs, should have just said super funds, and also assignments where arrangements were not on all fours with Everett and Gulland decisions. And we'll have a couple of things to say about that as well. Now, importantly too, the scope of the draft PCG, this is what it doesn't do. It doesn't replace, alter or affect the operation of the law. It doesn't create safe harbour for you. And also it doesn't impact the ATO's compliance approach around other issues that it might come across as it is looking at the structuring issue around this particular guidance. Now, before we go through the rules, just a couple of common phrases that appear all the time in the PCG. So when you actually go and have a read of it, you'll become accustomed to these categorisations. So when we talk about, if you like, most people refer to it as a partner in a practice in sort of old terminology, but that person is now referred to as an individual professional practitioner. So that's in effect the individual that provides the services to their clients or to the firm itself, where the individual and their associated entities have a legal or beneficial interest in the firm. PSI, I think most people are aware that personal services income, what that is, income earned mainly as a result of personal efforts of the individual. The professional firms that this applies to, so it includes, but it's not limited to, accounting firms, architectural firms, engineering, financial services, legal and medical. Now, there will potentially be others as well. And again, this is just an indication of the types of firms that it relates to. And obviously a professional is one that's recognised as a member of their profession. Now, obviously for accountants, there's a series of things, whether it's the Institute of Chartered Accountants, whether it's the CPA, et cetera, and obviously for architects, it'll be different. It'll be different again for engineers. Now, what's the compliance process? So essentially the way you work through these rules is like this. We identify whether the taxpayer is an IPP, i.e. individual professional practitioner. We look at applying the 2 gateway tests that we're about to go through. And if we get through those tests, if they're satisfied, we then perform a risk assessment. And that risk assessment will lead us to a traffic light assessment. In other words, that traffic light assessment, once you go through it, will indicate to you, hey, I'm either a low risk, in which case I'm in the green zone, I'm a moderate risk, in which case I'm in the amber zone, or high risk, which is the red zone. So traffic light system, an oldie but a goodie in terms of using that as a methodology. Last but not least, this needs to be reassessed on an annual basis. So this isn't a set and forget. This is something that you need to do annually. So obviously documentation will, a review and documentation will need to be put together. So let's go through the gateway tests. What do we mean by the gateway tests? So what we mean is that a number of these concepts were previously dealt with in the suspended guidelines, but I guess here they've been a bit more formalised. So gateway 1 is really just looking at whether the arrangement that you have in place and the way it operates, is it commercial? It's really it's really as simple as that. So can it be said, when you look at the arrangement in a holistic way, you know, is it a genuine commercial basis? And are the profits being distributed in that way? Is there appropriate documentation around it? And is there evidence that the way in which this structure has come about, that the purpose for which the structure was put in place has satisfied the objectives? So, for example, if you've restructured and you said that one of your commercial reasons for restructuring is asset protection, then presumably at the end of the restructure process, there is asset protection for that individual. Now, this may surprise some of you, but it is true that you know, I have seen some restructures where they do have commercial purposes that they want to achieve, and you get to the end and you look at it and you think, well, you told me it was about asset protection. You told me it was about asset protection. Is it? It doesn't seem to be, because we haven't met all the guidelines. And what are we going to do about that? So you do need to satisfy asset protection if that's a purpose for which the methodology was set up. Now, indicators to the commissioner that an arrangement lacks a certain commercial rationale. The arrangement is, one of the reasons could be that the arrangement is more complex than is necessary. It could be that the arrangement includes steps that serves no real purpose. It could be that you get a tax result which is at odds with a commercial result. In other words, the operation is making money and profitable. However, the tax result would indicate otherwise. And why is that? Now, there could be reasons, but again, that's just an example. The parties are operating on a non-arm's length or non-commercial basis. That's another reason. So, you know, it could well be an example of that is that financial arrangements are made on unusual terms that you wouldn't expect, either being low interest rate, no security, etc. They're the sorts of things that we're looking at there. And lastly, the arrangement results in little or no risk in circumstances where one would expect significant risk. So these are all the things that one needs to satisfy themselves about that commercial rationale type argument. Now, Gateway 2, assuming you get through Gateway 1, Gateway 2 is as follows. You look at Gateway 1, and let's say you pass that, you conclude that your arrangement is commercially driven. You then need to assess in Gateway 2 whether or not there's any high-risk features associated with the structure that you've put together. Now, the ATO considers the following as being high-risk features. Financing arrangements relating to non-arm's length transactions, exploitation of the difference between accounting and tax law, arrangements where a partner assigns a portion of their partnership interest in circumstances where it's different or materially different to the Everett and Gullen decisions. And last but not least, a high risk feature could well be the situation where there's multiple classes of shares and units held by, in effect, non-equity owners. Now, in terms of the Everett and Gullen decision, what are some of those differences that might exist there? So, in broad terms and in layman's terms, you could have a situation where you've got a non-equity partner. The non-equity partner has not been required to make a capital contribution. is on a fixed draw, does not have the ability to vote, doesn't participate in management, but notwithstanding all that, does an Everett type assignment. So that would be a situation which would be explored further in the event of an ATO audit. In terms of some of those financing arrangements that might be considered to be high risk, so this might be the situation where the way in which the structure has been put together is to convert non-deductible debt to deductible debt as part of the restructure of the business. And so that would be considered to be a high risk feature. But let's say that we are able to get through Gateway 1, and let's say that we are now able to get through Gateway 2. On that basis, we would then look at the risk assessment framework to work out what is the level of risk that the ATO would attribute to the structure that we've got in place. Now, it's a risk assessment methodology, as I said before, made up of 3 risk zones, low, moderate, and high. And the way you get there is basically you look at the risk zone that's applicable to your arrangement by combining a score that's attributed to each of the different 3 risk factors. We'll go through that in a minute. Bottom line is, if your arrangement does not have a low risk rating of green, then the ATO may look at your arrangement as being one which gives rise to inappropriate tax outcomes. So obviously the goal, if you like, is to have a structure where you're in a low risk rating. On the basis that you satisfy, as I said, gateways 1 and 2, you then self-assess that risk. That risk that you're self-assessing is given a score, and that score determines the approach that the ATO will take upon an ATO audit. So what do these scoring tables look like, and how do they work? So let's have a look. Now, some of you may recognise the risk assessment factors on the left-hand side, right? So you look at those, and I'll take you through them slowly because it's really important to understand how the tables work. Otherwise, you won't get the examples that we're going to give. But the first risk assessment is, let's have a look at the proportion of the profit made by the firm as a whole and how much of that is returned in your hands as an IPP, right? So if, for example, all of the revenue of the firm, or all of the profit, I should say, of the firm is returned in your hands as an individual, well, you are definitely going to be rated low risk because it's all in your hands, you're paying tax at your marginal rate, and there's actually no need to go any further. Like, that's the end of the ball game, right? But let's say, which is the case for many people, that 50% of the profit of the firm is attributable to, let me go back a step. Let's say that of the profit that you're entitled to, 50% ends up in your hands, then you can see from the table that you'll have a score of 5. And that will be the score that's attributable to you in relation to this particular risk assessment factor. Now, secondly, let's have a look at the total effective tax rate. Some of you might remember this as well from the previous suspended guidelines, where the total effective tax rate for the income received from the firm, I should say, by the IPP and their associated entities. What is the total effective tax rate, if you like, being paid by the IPP and the IPP's related entities? Now, again, if you're paying tax on all of that income at the rate, let's call it the average rate, it's not really, but let's call it the average rate of, say, 30%, then as you can see from the table, you'll get a risk rating of 4. Now, the last risk assessment factor is an interesting one, because what this wants you to do is it wants you to look at how much you're getting paid, and then how much is that as a percentage of commercially what you should be paid. So that's a real interesting question, and it is one that was being applied previously in a different manner, but that's essentially it. So you know, if you're getting paid $80 is in your hand, but you should have been 100, well then clearly you're not getting paid the full 100, and so your risk rating that is going to get attributed to you will be higher, right? So that's now in terms of this table, there's a couple of things you can do. You can just assess based on risk assessment factors 1 and 2, or alternatively, you can risk assess yourself based on risk assessment factors 1, 2, and 3. And different overall risk ratings are applied depending on which way you go. Now, what do I mean by that? Let's have a look. If you look at this schedule here, this adds up all the risk ratings from the previous page, right? And it gives you a risk rating. So, for example, if we looked at the previous page and said, well, I'm getting 50% of the profits that I'm entitled to, I'm returning it in my personal hands. Okay, I'm risk rated 5 for that. And if the tax rate that me and my group is paying is around 30%, when we look at all of it, that gives me a risk rating of 4. So I add the two together and I end up with a risk rating of 9. And as you can see there, you know, it puts you into that category of, depending on which way you go, you know, if you're only looking at the two of 5 and 4, and there's 2 risk factors, then obviously that's the aggregate that you end up with on this table, right? So it's really important to understand, A, whether you want to risk assess against the first 2 factors, B, against the second 2, B, against all 3 factors. But importantly, it's not clear in the PCG as to whether you've got a choice or not. It would appear that ideally the PCG would like you to assess against all 3 risk factors. That seems to be what it is, unless for practical reasons it's not possible to get that 3rd risk assessment factor tested, in which case you just look at the first 2. So look, let's try and that's essentially the long and the short of it. If, as I said, if you're using all 3 risk factors to be considered low risk, you know, you would need to get a score of 10 or less. So again, if you look at this diagram here, 10 or less gives you a green zone, which is good. If you're only looking at the first 2 factors, again, you'll be considered to be in the green zone, but of course you'll need 7 or less. And we would have fallen outside of that before using the simple example that I gave. Again, if the IPP returns all of the profit in their own hands, as you can see there from the 3rd dot point, then automatically you're in the green zone and there's no need to assess against any other risk factors. So look, let's look at an example and let's just see where we end up, because ultimately everyone's got different structures, and that's why there's no one size fits all. You need to really look at each of the structures that you're presented with, particularly in your client base, and work through and see where you end up in respect of each of the structures. If we look at case study 1, again, this has been lifted from the PCG and relatively straightforward, that really does bring home the way in which the PCG works. Now, if you have a look at this one, we've got Nicholas, an IPP in a partnership. His total income entitlement from the partnership is $600,000. Now, he's disposed of 45% of his interest to an associated company. Now, Nicholas returns 55%, therefore, of the partnership income in his own hands. And his tax liability as a result of that is $119,167. On the other hand, the company that receives $270,000, which is 45% of the profit that the IPP was otherwise entitled to. And assuming a 26% rate of tax, again, it's just an example, that tax amount would be 70,200. And so together, they would have a total effective tax rate, when you look at the tax paid over the total income that's attributed, there would be an effective tax rate of 31.56. So let's have a look at now at, okay, how does this look like on a risk assessment table? Okay, so again, looking through the different risk factors. Now, Nicholas has got 55% in his own hands, and because he's got 55% in his own hands, he's got a score of 4. Now, I don't know if you can see that on this slide. What I'll do is try and minimise this unsuccessfully. There we go. I'm not quite sure how I can get rid of this, but okay, I might give up. Okay, but as you can see, there's, oh, here we go. Did it unwittingly. So there's a score of 4. Now, then let's have a look at, and the score of 4, where does that come from? So if we just go back a few slides, you'll see that he's got 55% in his own hands, and as he or she, and therefore they've got a risk rating of 4 for that one. Now, what about the effective tax rate? The effective tax rate, Nick pays 119,000. The company pays about 70,000. And so when we add up the 119 and the 70, and we put that over the full amount of 600,000, the effective tax rate is 31.56. That gives a risk rating of 3. Now, that's really important because you'll see that by being at 31%, you get a risk rating of 3. Now, if overall the amount was 30% up to here, you would have got a risk rating of 4. So percentages matter is the point I'm trying to make, because the difference of even 0.5% is going to kick you into potentially, different risk ratings. So I'm not sure what we can do about that, whether it seems to be just a function of the way the tables work. Lastly, the remuneration returned in the hands of the IPP as a percentage of commercially what would be returned. Now, in this particular circumstance, the example says that it was impractical to determine an appropriate remuneration. So he's only going to be assessed, he or she will only be assessed against the first 2 risk ratings. Now, again, I think we just need more clarity around, well, when is it impractical and when is it not impractical? There is some indication in the notes, in the PCG about that, but it's I'm not sure that it's sufficient as I sit here today. Now, this is another example. So in this example, we're talking about an IPP that rather than the 45% we discussed before, let's say they dispose of 40% of their interest to a discretionary trust. So Jacinta, she's the partner, she's got an income entitlement of, again, the 600, disposes of 40% of discretionary trust. The discretionary trust, in turn, makes distributions, and it makes distributions to Jacinta's spouse of 180,000, and it makes distributions to the corporate beneficiary of 60. So as you can see, you really need to set up some methodology here to make sure that you've captured where all the money's gone and tax rates that are being paid. Now, in this case here, Jacinta's returned 60% in her personal return, and that means that she's got a tax liability of 132,667. The discretionary trust beneficiaries are Jacinta's spouse and the corporate beneficiary, and they receive a total of 240, being the 180 and the 60, and they've got their own tax bills to meet. Jacinta's spouse has got 51,667. The corporate beneficiary has 15,600. And again, when you combine all of those as the numerator and you put them all over the denominator of the gross income, you end up with an effective tax rate of 33.32. Now, again, as we go through the table and we do this, going through the profit entitlement from the whole firm, there's 360 on 600, that's 60% that she would get. Now, because she's getting 60%, she's on a risk rating of 4. So again, let me just go back to show you where that comes from so that it's all clear. Here we are here. So at 60%, 50 to 60, she's got a risk rating of 4, okay? Now, in terms of the total effective tax rate, Jacinta's got 132,000, the spouse pays about 51, the corporate beneficiary about 15. Again, numerator over denominator with a total effective tax rate of 33.2. And again, that provides you with a risk rating of 3. Now, remember that that if it wasn't for that, if it was around, let's say, the 30% mark, then that risk rating of 3 would be 4. And again, you would go up from a green zone to an amber zone. But as it stands at the moment, she'd be in the green zone if that's all it was. But she's also looking at risk. She's also looking at the risk assessment factor about how much money has she returned in her own hands versus what is the commercial benchmark. And as you can see in this example, she's considered various factors, which are in paragraphs 89 and 90 of the ruling. So it's probably a good time at this point to just quickly run through what the PCG says about this particular aspect, right? So essentially what it's saying is that in establishing, what is this appropriate benchmark, you need to look at, amongst other things, employees within the firm that perform commensurate duties or commensurate levels of responsibility, employees or principals in comparable firms, and relevant industry benchmarks. It then goes on to say that if you don't have an immediately comparable rate of remuneration, you might want to also reflect on the differences in duties performed, responsibilities given, personal risk and liability. I don't think it's that clear personally, and I don't think that's an easy exercise to do, but that's what is being encouraged in the PCG. So as I said earlier, we're probably going to need some better understanding around when does it become impractical to look at risk assessment 3? When can you say legitimately, look, I can't do 3 because it's impractical. I'm only going to rely on the first 2 risk assessment factors. But in this one, let's just roll with the example. In this one, we need to determine Jacinta's remuneration as a percentage of what she's determined to be the commercial benchmark for her services. And so using the formula of, well, she got remuneration of 360, which we can see from what she ended up in her own hands. We can see that it's been assessed that the commercial benchmark was 450. And so therefore, Jacinta's receiving about 80% of her commercial benchmark rate. Now, as a result of that, she's got a score of 5, which then gets added to 4 and 3, which gives her 12. And under the previous table, if we just go to the previous table, which determines she's at a 12, and so she's at an amber, right? So she would be considered to be moderate risk going through that process. So look, I hope that's clarified to some degree the work that's required, the considerations that are needed to be made in working out where you fall. So there's a couple of differences here between, the past versus the present. Previously, you could have satisfied 1 of 3 guidelines to be low risk. Now there's increased compliance for the taxpayer as well as the ATO, I guess. Scoring table and gateways mean that there's low risk structures might become moderate or high risk structures. And there's some examples there where, as an example of that, if you've got a professional practice with, multiple classes of shares units, no voting rights, and they're held by non-equity owners, may have otherwise been considered to be low risk, but now have a consideration of Gateway 2. What does that all mean? Similarly, dividend access share arrangements are going to be looked at closely as well. So I think the real issue here is that, well, previously, as we said, there's a number of, you could have been considered to be low risk, but now, in the draft PCG, if you look at similar scenarios, you could end up with a score of 9 and you could end up in a high risk rating. And as I said earlier as well, differences of 1% do matter. I mean, if you're at 29% versus 31%, that impacts your risk rating by the score of 1, which can take you from green zone to amber zone, or alternatively from amber zone to a red zone. So you just need to watch out for that. Particularly with base rate entities, I think we're going to see more distributions being made to companies. And so therefore, what will that mean? I mean, as a general observation, it seems that if you've got partners in firms with higher total income, they're likely to have a reduced risk rating from a total effective tax rate point of view, because assuming that they're going to return at least 50% of their income in their own hands, that'll give them a score. And then also, because their overall tax rate will typically be higher as a result of that, then rather than being at 30%, they might be at something higher than 30%, which again gives them a lower risk rating. So I think there are a couple of high-level observations that I can see pretty clearly in terms of how these rules are going to work. Now, other firms have also looked at some trends that might appear here, and some have suggested that, if you're on an income of around 300,000 and 60% of that is returned by the IPP, that will result in a moderate risk rating. That is, over 60% of income would need to be returned by the IPP to be on a lower risk rating at that sort of number. And again, if you're at somewhere between 300 and $1 million, which is a good problem to have, it might well be that a high or moderate risk rating is going to apply, even if more than 60% is going to be end up in the hands of the IPP. So they are some trends which have been identified by different commentators in the marketplace. So what does it mean from an ATO compliance perspective? Well, I guess what it means is, look, if you're in the green zone, my understanding is that there would have to be exceptional circumstances for the allocation of profit to be reviewed. And we've got some of what those things might be, that either the self-assessment is not correct or not adequately supported, or there might be, the ATO may become concerned that there's either high-risk features in place or that there's a change in an arrangement causing a shift towards being right on the border of whether you're complying or not. So they're the sorts of things that they're going to be looking at. But assuming that those are not present and that there's no material change in what you do from year to year, then they're just going to be interested to make sure that the calculations are okay, that there's no high-risk features, and so that tends to be where they're at. Now, if you're in the amber zone, again, ATO is more likely to conduct further analysis on the arrangement. And if you're in the red zone, then that seems to be the priority area, and where cases might in fact proceed directly toward it. So there, I'm not saying it's zero tolerance, but I'm just saying if you're in the red zone, then it's probably not a zone that you actually want to be in. So that's the sort of treatment that you can expect depending on what zone you're in. Now, in terms of transitional arrangements, there are some, as always. Now, firms that have entered into their current structures prior to 14 December, which is when the suspended guidelines occurred, they can continue to rely on those guidelines up until the 21 year, provided that their structure complies with those guidelines, continues to be commercial and don't exhibit higher risk factors, okay? Now, if you're a firm where these rules are pushing you now into a higher risk category, according to the PCG, there is a grace period up to 30 June 23 to allow firms to modify their risk arrangements. That's a Freudian slip, to modify their structural arrangements so that they can be lower risk. So what are the takeaway points? And I know we've covered a lot in a short period of time, bearing in mind that, this ruling goes for something like, and I'll just tell you, 147 paragraphs. So there's quite a lot in it, and it is jam-packed with examples, and we've really just provided you with skimming the surface in terms of what you need to be considering. But certainly, the tax landscape is changing, not just in this area, but a whole bunch of areas. And so, not something we should be surprised at. Will apply from 1 July unless you fall within the grace period. So have a look at whether those transitional arrangements will in fact apply to you. The gateway tests are critical. You can't proceed any further looking at risk assessment unless you're satisfied that the gateway tests are properly assessed and you fit within those. You've then got the traffic light assessment system, looking at those criteria that we looked at to work out what your risk is. And last but not least, there's going to be an annual assessment. So this isn't a set and forget. It is something that you need to be cognizant of from 1 year to the next, just making sure that you're continuing to fulfil the relevant criteria of the compliance guideline, because the way we've just talked about it, that's actually how it's going to be applied in practice. So I think that's all I wanted to say, and I think I've taken up the full time as well. But Daniel, if you're still there, I think that provides people with a pretty good snapshot of where things are at. I just wanted to say too, by the way, before we proceed, is that I do want to say these points actually. That just briefly, there's a few things, inconsistencies and unexplained concepts that will require further work. So the PCG does not give examples of professional firms running their practice through a corporate structure. So that's one. Two, it doesn't mention franking credits and how are they going to be taken into account in determining remuneration, or for the second risk factor, first risk factor or second risk factor. It doesn't deal with profit dividend payments where there's timing mismatches, i.e. if my profit is this year, but it's not paid until a year down the track or 2 years down the track, what does that mean? Because many of you will know that running a business means that you're relying on cash flow, so you might want to keep the cash in the company. How is that going to work? It doesn't deal with superannuation contributions, and it doesn't deal with fringe benefits tax in terms of how that will interact with all this. So I think there's still quite a lot of questions remaining. I know that submissions are being made, so we'll wait and see what's in those submissions and you know how this PCG will change, if any, between now and the time it's released. So,
Mark, if you don't mind, I'm just going to go through a couple of the questions that came through, and thank you so much for that. The feedback has been really good. And one of the things, Mark, would you be happy for your slides to be available at the end of the presentation?
Yes, I will. That's fine.
Fantastic. But Mark, just on your position at the ATO, Leanne Spiteri asked a question. It says, "Dear Mark, do you consider that the professional partnerships are safe from the ATO's wrath in terms of dealing with partnerships, appointing non-individual as equity partners when ultimately the personal services of the individual are part of the arrangement? A separate observation I make is that superannuation contributions, which may include carried forward concessional contributions, may impact the average rate of tax."
Look, absolutely. So we need more guidance on that super aspect, which I think I've covered off on, Daniel. So we just, I don't know what the answer is there because I don't think there is one at the moment. I was actually speaking about the super aspect of this with our tax technical director at BDO this morning, and this is an issue that we're just waiting on. But in terms of the partnership question, I think that's what this is all about. It's about I think if it would appear to me that if you're a fixed draw partner, then it's going to be very difficult to not receive all the income in your own hands, is the way I've read this PCG.
Yeah. There's another question here from Edward Bernard, which says, how do you expect we will practically report these risk assessment tests to the ATO?
Well, that's a great question. It's a self-assessment system. I haven't read anything that says you need to specifically report this to the ATO in some way. So, but, the ATO knows who the professional service firms are. So I think, you just need to be satisfied that with your self-assessment is correct. And if you've got a concern about it, then you might, from a professional practice perspective, it might be worthwhile to get a second opinion.
Yeah, and there's just another quick one here, Mark, which I think you'll be okay with Rochelle Hamilton, who said, do you need to report on this risk factor formally, or is it done via the tax return?
Okay, I've not read anywhere that it's done on any of those two bases. So it's my understanding is, from everything I've read, that it should be self-assessment. So not something that's written on your tax return as such. But I could be, unless I've missed something, that's my understanding.
Yeah. And I think I'll go the one last one, Mark, where it says from Doris Wang, who asked, does this apply to a sole practitioner trading under a 100% owned company structure?
So there are no examples in the PCG about corporate structures. And I think I mentioned that. So I can't see why this wouldn't apply. But again, there's nothing in the PCG about that.
Yeah.
But look, in that scenario, if you're the sole owner, presumably you're the only person that can ever get income. So yeah, that sounds like a pretty safe structure. But again, there's nothing in the PCG about it.
Okay. Well, look, we'll leave it at that, Mark. And on behalf of BGO, and I know the wider audience, we'd just like to thank you for the effort that you've put into today and just the way that you've been able to shed light on this really important topic. And I can see from the number of questions and the huge level of engagement that this has been something that's been really well received. So thank you for that. And thank you for willing to give back to the community. And it's a really important part of what you do. And we so much appreciate that you've done that for us, Mark. So thank you so much.
No problem, Daniel. Thanks
just to reiterate, we will make the slides available. So what we'll do is we'll send an email to all attendees, and we'll make once Mark's gone through the slides and effectively give us a final copy, we will send a link to all attendees, and you'll be able to download your own version or your own copy of the slides. And of course, if you do have any questions, I'm sure that Mark would be happy to take those on, and you can discuss whatever arrangement it is from there that you need if you do need any further help. So Mark's always available and is a very great source of a reference point too. So thank you, Mark.
Cool. Thanks for having me.
Okay, well, thank you, everybody. Thank you for joining us. And look, as these topics come up going forward, we will definitely be looking to present more on similar or topics that are hot topics in the future. So stay tuned, stay posted, and we'd love to have you on board again. Thank you.